Hello, this is part 2 of the video on factors that affect bond market prices, and here you see a set of factors that may affect the bond markets, or we call debt markets. So the first set is called macroeconomic factors. We are talking about the GDP growth rate that measure the economic growth. So sovereign solvency. In other words, what is the overall indebtedness of the public sector, of the government? So, for example, you could be looking at deficit to GDP ratio or debt to GDP ratio. Also, you could be looking at the situation with the demography. In other words, population aging. So, to what extent the country what portion of the population is employed. For example, you could be looking at employment to population ratio. And the countries that have very high, uh, for example, and countries that have got very low employment to population ratio tend to exhibit lower overall longer term um, growth rates. Central bank policy may also play a role. So in the past financial crisis, central banks stepped in to aggressively cut rates, and also they engaged in monetizing debt through so-called quantitative easing, and that suppressed the long-term yields because that central bank buying of the long-term bonds created artificial demand for those bonds and kept the yields low. Political factor examples we already mentioned Brexit earlier. So sometimes you may have incompatible economic and political frameworks, such as the case of Eurozone, where they've got a monetary union via euro, but there's no fiscal union in terms of budget, fiscal policy, and that caused a series of sovereign debt crises across several countries in the Eurozone. One of them was actually particularly well covered in the media, and it was actually there was also a risk of Grexit, Greece exiting the Eurozone. So Greek technically there was a default before the EU bailed them out, and the bond yield skyrocketed. There is also a relationship between junk bond yields and the GDP growth and also the stock market. We will also look at a graph. And Venezuela bond yield spike. In Venezuela, you've got a situation with inflation, which was actually created by the government, which got out of control. So you got hyperinflation, and it's the highest inflation rate in the world at the moment. So let's look at this concept of so-called political risk or sovereign risk spread. There is a really interesting article that you can read. If you go here, and you can actually download it, so it's also in the folder. So let me just go through the abstract of this paper. Political risk and international valuation. Measuring the impact of political risk on investment projects is one of the most vexing issues in international business. One popular approach is to assume that the sovereign yield spread captures political risk and to augment the project discount rate by this spread. So the article argues that this may be flawed, and while the sovereign spread is influenced by political risk, it also reflects other risks that are likely included in the valuation analysis. So it may lead to double counting of risk. So they propose to use political risk spreads to undo the double counting in the valuation of international investment projects. So this is basically talking about risk, political risk that is, for example, in the case of Brexit or Greece, specifically the risks that has arisen from within, and the sovereign yield spread, which may actually capture other things other than the political risk spread. So read the above article and also evaluate whether or not the concept of political risk spread itself could be flawed. So you will only be able to answer this question, to have an answer for this question, after you've read it. So why yes or why not? So this is the central bank policy versus the yield. So we got something called chicken and egg problem. So this graph shows you a long-term graph that plots 2-year Treasury yield, 2-year U.S. Treasury yield, and Fed funds target rate. In other words, Fed's benchmark rate, and it's the upper limit. Usually they've got low range and high range. If you remember, we actually covered it several times in the past, and they say, for example, we target the rate to be between 1.5 and 1.75, right? So the upper limit, they took the upper limit. In this case, it would be 1.75 is the upper limit right now. So what appears is that sometimes central banks get behind the curve. In other words, the curve here is the yield in other words. So 2-year yield may have been leading the central bank from time to time, and you know, especially in this recessionary running up to a recession, sometimes central bank may be slow to act to cut rates, even though the yields also already signal that the growth may be slowing. How they signal? Well, they fall, and as you can see, it's in several occasions here, running up to recessions here, early 90s here, after the dot-com bust, short basically recession that happened, I think, less than a year, and this is the one that happened during the latest financial crisis. This is a 3-month T-bill rate yield as Fed versus the same benchmark rate in the US. So I'm showing you the shorter, basically, one versus the US because this may be even more sensitive. It's the shortest end of the yield curve, right? So it's all the way from here, 1990s, and as you can see, the 3 months basically yield seems to be falling first before the Fed action. So Fed may have been watching this short end before action. They may have been taking this into account when they were making their interest rate or so-called FOMC decisions. So here, have a look at the central bank rate versus stock prices. So there is a so-called theory of risk and risk aversion. I think it's very old theory. You may actually want to revisit it, and you can see that there is some kind of relationship between risk assets meaning risky assets and safe or perceivedly safe assets such as US government bonds. And risky assets in this case could be stocks such as S&P 500. And you can see the Fed funds rate is the red one. So, and the S&P 500 is the blue line here, and the green ones are recessions. Notice that when the Fed funds rates are low in the last period, it's very clear that the stock prices were up. So the central bank, when they cut rates, they're basically making the cost of money cost of credit more accessible to businesses, individuals, the households, etc. So that it kind of has an effect of boosting economic growth whenever the monetary conditions are tight, right? But as you can see, it tends to correlate with also the stock market. Stock markets increase, stock markets rise. So some of this money may end up actually benefiting the companies, specifically stock prices. Economic factors that affect corporate bonds. So far I mentioned the treasury bonds, right? And here corporate bonds are affected by interest rates, inflation, yield curve, and economic growth. Depending on the economic context, the factors may put upward or downward pressure on the prices of bonds. For example, economic growth can be positive for corporations, leading to increased revenues and profits for companies, making it easier for them to borrow money and service debt, which leads to reduced risk of default and lower yields. However, extended periods of economic growth lead to inflation risk and upward pressure on wages. So when, for example, central bank cut rates, it actually benefits the companies because their cost of borrowing becomes less. In other words, they can refinance the existing debt by borrowing cheaply and repaying the higher cost sort of loans. At the same time, if the interest rates stay low for a long time, this leads to inflation risk and which means like wages have to be higher, and if the wages are higher, the cost is especially higher to those companies whose largest proportion of cost is the labor cost. These are let's say intellectually intensive industries such as consulting and banking and accounting, audit, and other things. So this may put upward pressure on wages in the longer term. Now, higher wages begin to affect profit margins, right? So making them more vulnerable to slippage in economic growth. The inflation risk leads central banks to raise interest rates. When the risk-free rate of return rises, corporate bond yields must rise as well as to compensate. The high yields add to increased costs, creating even more vulnerability to economic stumbles. So note that corporate bond yields consist of two parts. One is the so-called risk-free rate. The second is the credit risk spread or risk spread on top of this risk-free rate. And that spread depends on the growth in the economy, whether the economy is growing or not. Yields can skyrocket as costs mount if the economy slips into a recession because and revenues fall. Investors begin to price in an increased chance of default, and this is what actually makes this spread or risk spread, which I mentioned earlier, larger. So when growth concerns begin to dwarf inflationary risks, the central bank cuts interest rates, leading to downward pressure on corporate bond yields. Decreases in the risk-free rate of return make all yield-generating instruments more attractive. So when central banks cut rates, you saw in the previous graph that stock market benefits, right? But also corporate bonds also benefit, especially if the risk spreads were significantly high. They have room to fall. Now, the most positive scenarios for corporate bonds are economic growth due to productivity growth, which doesn't spark inflation. Now, this is an ideal scenario for bonds. If you have some kind of technological driven economic growth, this could be really great for corporate bond investors because overall yields will fall. The most negative scenario is a weak economy with inflation risks that lead to higher interest rates. We're talking about stagflation. The stagflation could be the worst scenario for corporate bonds. What happens is that inflation is high, the bond prices are suppressed on the downside, and because there is no growth or lack of it, the potential for the yield spreads to tighten or to fall is also limited. So overall, you've got higher nominal risk-free rate and also higher risk spread. So add them together, you've got very high yield, which means very low price for bonds.